Hello and welcome to Naifa Live. I'm your host, Zach Hewells. We have a great speaker lined up for you today, followed by some awesome breakout sessions that we just started this year in 2021, so stick around for those as well. But to kick off our meeting properly, I'm going to pass things over to John D. Richardson of Naifa, Tennessee, with the Pledge of Allegiance.
Please join me now for the Pledge of Allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you, John. And now I'm going to turn things over to Naifa CEO Kevin Mayu for some Naifa announcements.
Hello, Naifa Nation. I'm really excited to be here today to bring you 5 updates and one big piece of great news about our association. First, a few updates. First, the Naifa Family Response Fund. We originally established the fund to help Naifa families facing challenges caused by hurricanes devastating the Gulf region and other locations on the Eastern Shore. Since then, we've continued to expand the fund's coverage to cover COVID-19 expenses, then expanded it again to cover the Western wildfires, and have recently expanded it yet again to cover those Naifa families that may have experienced hardship during the recent ice storms in Texas. If you need assistance, or if you want to provide assistance through a donation to help other Naifa families, please know that the Naifa Family Response Fund is here for you. You can learn more at members.naifa.org/fund. Second, Naifa has been tapped along with other industry associations to join LIMRA in a new initiative called Help Protect Our Families. The first leg of the year-long initiative focuses on closing the coverage gap that we know exists for life insurance in American families. The first initiative is focused on helping bring awareness to agents and advisors that now is a time to check in with your clients and ensure that adequate coverage is still in force, and if not, to start conversations on long-term care and life insurance. You will see us participate in this initiative through social media by using the hashtag #HelpProtectOurFamilies. We are measuring our social media power, so please like, repost, and retweet when you see Naifa's messages on social media. You can learn more about this campaign at naifa.org/protect. Third, we would like to formally introduce to all of you our new partner, Insperity. Insperity is known for its HR, benefits, and payroll solutions that it distributes to its nationwide network of Insperity employees. We are partnering together to connect Insperity regional vice presidents with Naifa chapter presidents and membership chairs to create a new influential network that can offer additional value to your business clients that may meet an outstanding or outsourced HR solution. The partnership includes 75 new members to join Naifa and a year-long marketing agreement to help network together Insperity employees and Naifa members. Insperity will also be a sponsor of our Business Performance Center, where they will provide content around talent development and recruitment issues. Welcome, Insperity. We're glad you're with Naifa. And speaking of the new Business Performance Center, that brings us to our fourth item, the Business Performance Center Impact Week. Join us March 23rd through 25th for a fantastic lineup of speakers and a special track brought to us through our Advanced Practices Symposia, a collaborative program brought to you by Naifa and our partners at the Society of Financial Services Professionals. The event is 100% virtual and 100% free. Just another way our partnership with FSP is doing more for the industry and the professionals in it. And fifth, advocacy. In case you missed it, we are running a survey to get your feedback on possible consequences of the PRO Act, which could change your status from contractor to employee. You can see the survey on every page of our website, and I encourage you to take a few minutes to complete the survey so that we can report back to Congress how Naifa members, as the backbone of the industry, feel about this proposal and its impacts on the professionals in the insurance and financial services industry. Within 2 days of the survey being live, 800 Naifa members have already shared their perspective, so be sure to add your voice to the final results. And finally, the great news. We had a record number of new members join NAIFA in February. Our numbers grew thanks to our second 100% agency, Centric Advisors, led by Zach Majors, who signed up all of his advisors. Our partnership with Emeritus, who signed up 57 of their elite study group for young advisors that they call growth leaders. And due to the hard work of all of our membership chairs who are out there actively engaging with our current members and asking new members to get to know NAIFA. More members help make NAIFA stronger, and a stronger NAIFA is vital to the success of this industry. To make membership referrals easier, to make retention and membership recognition even easier, I'm proud to announce the launch of our new Find an Advisor tool that is powered by our new member community called naifaconnect.org. You can use this on your desktop, your phone, or tablet and log in with your primary email address that you have on file with NAIFA. If you need help, you can always contact our member services team that supports the entire NAIFA Nation via email, live chat, or through your phone. In fact, let's make sure to welcome all of our new members using the chat feature on this webinar right now. Go ahead, welcome our new members to the NAIFA family. And congratulations to all those new members. We are so glad that you're part of the industry's largest, oldest, and most influential professional association, NAIFA. Now, without further ado, let's turn our attention to today's NAIFA Live and get dialed in on new ways to expand your business. Today, we welcome Phil Raymond, who is an expert in building networking programs for career shops. Phil will focus his talk today on CPAs and why they need to be key members of your network. Phil is going to break down how a CPA firm works, what conversations they are having, and how you can pair together to create a mutually beneficial cross-referral system to bring you more leads and to better meet your clients' needs. Phil, welcome to NAIFA Live. We are looking forward to your presentation.
Thank you, Kevin. It's good to be with you all today. I'd like to spend the next 45 minutes or so sharing some CPA perspectives that I've acquired over the last 22 years working in that space. I want to be clear that this isn't a program or a process or a service that I'm soliciting. I'm beyond that stage. I just want to share some best practices with you today that I hope will be helpful as you grow your business model. The way I got into this was as a first line management person for several major carriers. The challenges that new advisors and even experienced advisors have on a daily basis is prospecting. For the first 5 years, I would guess that the average advisor spends 90% of their day prospecting. And that's not what we recruited them to do. We want them to be out there to share knowledge and to help clients do better financially in their lives. So when we looked at a survey done by the top of the table, it was kind of revealing for us. It showed that MDRT people, who by the way are only 1% of all agents in the industry, only have 19% of their time face-to-face with the client. They work 58 hours a week. So it's a large task, a lot of hours, a lot of work. Quarter of the table advisors spend 48% of their time face-to-face with clients and work 54 hours a week, slightly fewer, but you can see that they're using their time much more effectively. And top of the table producers spend 53% of their time face-to-face with clients and work 51 hours a week. What was even more significant when I looked at this was that 80% of the largest and best cases the top of the table advisors had came from CPAs and attorneys. Since 1993, CPAs have been able to receive commissions and contingency fees. So it's no secret, most companies, whether it's wirehouses, insurance carriers, investment companies, are looking to partner with CPAs because of their trusted advisor status. And we'll talk about that a little bit as we go on today. Over the years, we've developed a fail-safe formula for success. It's 2-2-1, it's pretty basic. We believe that you need 2 target markets. You've got to become an expert in something rather quickly. You can't be going into appointments guessing where the hot buttons are. You should know most of the questions and have most of the answers for that target market before you hit the door. So it's 2 target markets. The second 2 is 2 strategic alliances. I believe you need one CPA and one property and casualty, or you could have two CPAs. We have advisors with numerous CPA contacts and relationships, but I think you need two to provide you access to tier 1 and tier 2 clients. Maybe they provide you 1 or 2 introductions a week, 3 or 4 a month. And the last one is the one, which is basically you have to master referral talk. These strategic alliances can't continually tee you up people. At some point, you have to learn to replicate them. The last thing that I'd like to share with you is a belief I have that the 5 assets we control as individuals are basically focus, time, energy, skills, and choice. When Warren Buffett and Bill Gates were interviewed in separate venues and were asked to attribute one word to their success, they both said focus without any hesitation. They know who they are, what they do, what they don't do, and what they want. It allows them to allocate time, energy, and skills to get what they want in life. I mean, time really by definition is only how you live your life. If you're not spending your time getting what you want in your life, I would suggest you might be wasting part of your life. Energy and time are finite skills. We only have so much of it. Whether you diet and exercise, your energy will dissipate at a certain point in the day. If you're not developing competency and skills that help you with your target markets or help you with your deliverable, you're going to have a challenge. I mean, it's really competency, dependability. Those are things that are table stakes that have to be provided to a client. And the last one is choice. We make decisions every day. We make choices every day. And it's tough to make the right choices unless you have the focus knowing how you're going to spend your time, what you want, and how you make good choices versus bad choices. So why partner? It's pretty simple. At the end of the day, you want to leverage established client relationships. Now, we're in a relationship business. The challenge is pretty clear. Relationships take a long time to build. If I were to ask you how many close friends you have, I would guess it's probably 3 or less, because as Covey says, you have to make a lot of deposits to develop a good relationship. You're going to take withdrawals, and if you over withdraw and don't put enough deposits in, you'll be bankrupt in the relationship, which he attributes the cause of most divorces, and I think rightfully so. So when I looked at building a model, I said, why don't we really find a way to leverage existing relationships and other financial and professional disciplines? The second reason is you can enhance trust and credibility. We'll talk about why the CPA is the most trusted advisor a few slides down the road, but the reality is, having been a marketing major in my MBA, I learned one simple rule that's stayed with me for years. Not much else has changed. A lot of things, delivery systems, technology have changed, but the one thing that hasn't changed is it's easier to market from the inside out than the outside in. I'd rather be on the same side of the table with the CPA as part of their organization and working with a client. Provide needed value and services. Most CPAs are looking for ways to, in fact, expand their value footprint. In the last few years, I've seen an interesting dynamic. P&E firms are buying CPA practices because they want access to their tier 1 clients' wealth, and they're outsourcing the CPA work. Their clients need, just as our clients need, assistance in wealth and risk management. And we can help them through a partnership, provide that to the clients and increase their value footprint. The last is market access. And of course, we want to be able to identify tier 1 and tier 2 clients. I'm not saying that we're going to cherry pick. That's a bad approach to a partnership, but we want to understand where the tier 1 and tier 2 opportunities are. And we want to be able to access them with some credibility and some trust. Again, we want to be on the same side of the table as a CPA. And at the end of the day, it's just a smart business model. I'll share with you our 4 pillars in our business model a little later in the presentation. So what do clients want today? What we found is that they want trustworthy, objective advice. The canon of ethics for a CPA basically says independence and objectivity, and they want somebody they can trust. Well, all surveys that we've done in the last 25 years show that the most trusted advisor in professional disciplines has been the CPA, above lawyers, above financial advisors, above bankers, stockbrokers. They are far and away the most trusted advisor. They want an integrated vision. They want to know that if they do something, it's going to work in a plan. It'll have an effect on either positive or negatively on everything else that they're doing. CPAs are uniquely positioned to have that vision. They want responsive service. They want broad expertise and they want product understanding and they want to get it all in one place. And this is going to be exasperated at the end of the day with millennials. 80 million of them they think differently, they buy differently, they expect different levels of service. And it's going to be challenging because, as you'll see, a majority of the owners of CPA practices in America are 50 years or older. And there's a disconnect, there's a gap between the millennials and the way they've been doing business in their practice for years. So who's really calling the shots? At the end of the day, the AICPA is a little on record as saying that they in the future control the financial services world because they think they have a better ongoing relationship and access to more of the client information and, more importantly, an expertise in taxation. I'm not so sure that's true, but if they are in fact going to be the quarterback in controlling access to a client, I think it's pretty critical for us to take that in consideration in the way we build our business model. So why are the CPAs a trusted advisor? Well, we know that people do business with people they know, like, respect, and trust. But there's a book out that I would suggest you read by Galford, Green, and Meister called The Trusted Advisor. And they define trust in the CPA world as C, which is credibility. CPAs are perceived to be experts in taxation. The R is reliability. CPAs tend to do what they say they're going to do when they say they're going to do it. And the last is intimacy. I really look at intimacy as into me see. It's client understanding, it's empathy. In fact, we joke in many interviews with CPAs that clients probably tell them more than they want to know, more than they're comfortable knowing, because they want to minimize their tax exposure. The reality in small communities, the CPA probably knows when there's going to be a divorce before the spouse does, because one of the two spouses is lining up assets or having discussions about the impact on their financial situation. And it never goes anywhere. So that intimacy, credibility, reliability build the trust. The only divisor, which is the S, that's supposed to be a divisor line. I couldn't quite do it in the graphic, but the S is your motivation for adding services. If your motivation as a CPA is ever to make money, you're going to dilute your trust with your client base. And that's a bad situation. There's 3 E's you need to understand that the CPA world really respects. The first is education. Today, to sit for the CPA exam requires 150 college credit hours. That's 25 more credit hours, excuse me, than most curriculums in colleges today. And with the cost of college, that's a major commitment. In fact, that extra year of 25 credits, more people are going to law school than sitting for the CPA exam. The second one is experience. They can't hold out their designation unless they've been practicing as a CPA for 3 years. And the third E is examination. They believe that their exam is tougher than the bar, and it may be. And they take great pride in the fact that they're able to pass that exam and have that CPA designation. So one of the things that we learned from Stephen Covey in his 5th habit was, and this is the biggest mistake I've seen carriers and firms make when they're trying to build partnership programs. All the CPAs out there know what we need and what we're looking to do. The reality is we've got to seek first to understand them before being understood. So what are their top concerns? Well, the first is client retention. Their clients are really an annuity. They've really invested a lot in that relationship over a number of years. But in reality, they're all rentals. And none of us own our clients, whether it's the attorney, the financial advisor, the CPA, the banker. They're passing by us at a stage of their life. They may go on and retire, die, sell their business, move, any number of issues. So we have a responsibility, and that is, while they're in front of us, help them in many ways as we possibly can, add value at any point in contact that we have with them. And the last thing is, as business owners, we should find a way to generate revenue and get paid for that work. The second concern they have is client acquisition. I'll share with you a few questions I use to level the playing field in the first interview with CPAs, but client acquisition is a challenge. It's been word of mouth for a number of years. COVID's kind of changed that a little bit, but it's still a challenge for them. They probably, in the larger firms, have a 93 to 95% client retention. Smaller firms may have a retention as low as 70%. So they're constantly trying to feed that turnstile of new clients. Stagnant revenues has been an industry challenge. There's a glass ceiling on billable hour rates. I think white shoe firms probably bill in the major cities at $500 an hour rate, but in more rural communities, you may see rates as low as $200 or $300 an hour. It's resulted in stagnant revenues of 3 to 4% in the last decade. So they're really being challenged in their business model to pick up revenue opportunities. The next two are pretty much paired together: business evaluation and succession planning. There'll be more CPA firms for sale in the next 25 in the next year rather than in the last 25 years combined. The reason is they're all my age. They're baby boomers looking for exit strategies. What that's done, unfortunately, is create a buyer's market. What used to be worth 1.2 times billables is probably now worth 0.9 to 1 point billables, only because of the number of firms for sale. And if you're not paperless, you're probably gonna have a tough time selling your practice. So succession planning is huge. We really use that as a key point in our program, in that they all have, we'll talk about how we focus on 1 to 5 equity owner firms, but most small firms have a younger associate that they'd like to really take the firm over and has really been promised that opportunity for the hard work they put in. The challenge is that the CPA can't afford to pay them more money so they can do an installment buyout for them. So we really build this program in, let the junior guy run it, generate 5 to 15% of billables, and use that as part of his installment buyout. So succession planning is a key issue. Quality of life is huge. The average CPA works 2,500 hours a year. They're not looking for more work. They want to go to more soccer games with the kids. They want to spend more time with their families, just like we all do. Technology is going to impact their margins, especially in the attest functions, audit, review, and compilation. What used to take 8 hours in a firm to gather data to do an audit, now with software, probably takes a tenth of that time, and the margins are shrinking because of that. The risk isn't shrinking. Enron's an example of the risk of audit. It put Anderson out of business. The risk is still there. And we said millennials in 5 years will be 50% of the workforce, and they really aren't fans of paying for compliance. And the reality is a 1040, 1120 is just compliance with the IRS to make sure that everyone's filing and disclosing income. And attest work, audit, review, and compilation is the SEC disclosure for public companies. So investors are fully aware of what they're getting into. So the triple jeopardy is that 61% of CPA partners today are over the age 50. 52% were aware that they've got people who want to leave in the next 5 years. I'll tell you a quick story. I was with a firm in New Jersey with 11 partners, a very nice sized firm. And 4 of the partners have expressed that they want to leave in the next 3 years. And the, of course, remaining partners were pretty excited because they'd been waiting in the queue for their chance to run the business. And I asked them what their business plan was and what their sinking fund was, or what their plan was to buy out the 4 senior partners. And the response was, well, we'll just take it out of our earnings, and they'll just have to find a way to make that work. Well, the reality is the remaining 7 partners are going to have a tremendous workload just taking over the clients of those 4 partners. And those are probably all tier 1 clients that those partners have had for years, probably the better clients in the practice. So retention is a critical issue when they leave. And I told them, I said, sadly, the reality is you're probably gonna have to sell this practice to a big regional firm to guarantee the payouts for the 4 senior partners. And the 4 senior partners looked at me and said, yeah, you're probably right. So there are challenges. 54% of multi-partner firms don't have a written or approved succession plan in place. That's not surprising. I think that probably would apply to most small businesses, but it is a challenge for them. We talked about client retention as one of the issues keeping them up at night. 95% of CPA profits come from long-term clients. It costs 11 times more to attract a new client than it does keeping an old one. Their studies show, in fact, and this is taking all size firms into consideration. Smaller firms, especially, if all you have is a new tax client, the reality is if you bought them on pricing, you've got less than a 2-year retention rate for a single service client. If you double the number of services you provide and increase it to 2, you're almost at 4-year retention. And you can see what happens when you add a 3rd service. This is a large reason. Remember I said that their clients are like an annuity. They have to do the work every year, of course, but that client base is going to file tax returns every year as long as they're alive. So that's part of their cash flow asset is their client base. We think by adding services and financial services, we can help them dramatically improve the chances of longer service and loyalty of clients. Their studies have shown that 36% of their business clients are thinking about changing firms. And partly, this is exacerbated by COVID, but the reality is it's because their CPA doesn't really regularly check in with the needs and their changing needs of their business model, whether they've expanded, whether they've merged, whether they've bought a new business. They just feel like that they're not getting the kind of attention that's going to be required for them in these volatile marketplaces going forward. In addition to the 36% who are likely to switch firms, 55% of business clients have been approached by another firm in the past year. That's kind of amazing when you think about it. What's happened, of course, is that large firms, it used to be the big eight when I started, now it's the final four, recruit the brightest college accounting majors every year. And they're just loading up the best and the brightest people. And they've got to find a way to keep them busy. Well, years ago, they wanted to get rid of the small business client because they didn't think there were margins and profitability. Well, now that's changed. They've got capacity, so they're looking for ways to get that business back. So they're targeting smaller firms' client bases. They used to be able to make a lot of money on the attest and audit functions, but now they're going back to building back some of that base that they just kind of discarded over the years. So the outlook for CPAs is bright. I use this analogy all the time. 45% of business owners think their support needs will grow, and 24% of individuals think so as well. And the reality is, in 1944, the top marginal tax rate was 94%. In fact, Ronald Reagan declined a movie deal for $1 million because he wasn't going to do it for a net 60 grand. They had to do it to really pay off the war debt. Well, we now owe $30 trillion. We're just going to send out another $2 trillion, which, by the way, is almost equal to an annual total of the income tax collected by the United States IRS. So that's not a small expenditure. When I work with our young advisors, I kind of keep things in perspective. There's a quick little diagram that I like. It takes you to $1 a second. It will take you 11 and a half days to become a millionaire. If you could save $1 a second for 11 and a half days, you'd be a millionaire. To become a billionaire, you'd have to save $1 a second for 31 3/4 years. Big difference. To become a trillionaire, you would need to save $1 a second for 31,710 years. And we owe 30 of those. So taxes are going up. The demands are going up. The demands for help and planning and guidance are going to increase dramatically. There's some threats. I mean, we could go to a fair tax, a flat tax. There are any number of regulatory issues that could impact their business, but I don't see that happening anytime soon. I think they're going to have a pretty prosperous next decade. Post-COVID, I won't go through everything, but their growth rate's slower than they had budgeted for. 21% of firms are down 11 to 30%. Half are down more than 10%. What's really interesting is now they're going to have to manage collectibles, receivables. They may have to change their engagement fees or what's included in the engagements. The bright side is that 55% of CPA practices have launched a new service in 2020. Now, 88% of those involve PPP, but the trend is there. They're having to replace lost revenue sources. They can't replace the 4 months they lost last year with a delayed filing in July. That's going to catch them with the filing this year. But the reality is they're more open-minded now than ever to launching new services. So I think the time's pretty favorable for someone looking to partner with CPAs. So let's talk about positioning the CPA to be an option. There's a couple of things when we built our programs, that we wanted to consider. We wanted to be in alignment with the CPA and what they believe to be true and what they were hearing from their clients. So we built it based on marketing, not solicitation. We want to let your clients know how we can help them in new ways, what kind of new problems we can solve, and what those solutions may look like. We also stress advice, not sales. We get back to trading on the 3 E's. We want to empower your clients to make better financial decisions by providing them better education. And we think if we do that, it's a win-win for the client, for the CPA, and for us as well. The fact is, CPAs are already in our business. Everything we do passes first through a tax lens, whether it's a tax-free death benefit, whether it's moving from sub-account to sub-account on an annuity without a taxable event, whether it's capital gains, ordinary income, whatever it may be. And anytime you do a financial plan, you're having all of these discussions. We're not giving tax advice. We're not licensed to do that, but everything we do kind of passes through that lens. In reality, as we sit here today, there are 40 CPA practices in America that manage at least $1 billion each of their clients' money. Not because that's the business model they want to be in, but it's a service they're providing to accommodate and retain clients. So what does it do for the CPA? We position their firm to be an option. It adds potential new additional value. A well-run program will generate 5 to 15% of billables for the advisor and for the CPA. Now, I will tell you, ours isn't the only program that works. There are a lot of diets out there. There's no magic pill. It's basically, you've got to follow the diet. You've got to stick to the plan. And if you do, you've got a pretty good chance of getting there. And we'll talk about the challenges of doing that a little later in the program. It'll help you strengthen and retain relationships. Remember, we said that client retention was one of their key issues and concerns. Flat revenues was a concern, so we've addressed 2 of those. We're going to generate new revenues. We're going to improve client retention, and I'll show you how we use it to attract new clients to their tax and accounting practice. The little footnote at the bottom is pretty important. When Moss Adams did a study a few years back, the realization rate for their financial services work was about $1,250 an hour. You recall earlier that we said that the average CPA may charge anywhere from $300 to $500 an hour. That's a strong realization rate. The other thing that you should consider is this. For every $1 million of firm revenue, that CPA influences directly about $100 million of assets under management. Now, nationally, one equity partner firm will generate somewhere between $400,000 and $500,000 of billables. So they're going to influence somewhere between $40 and $50 million of assets under management. A 2-partner firm, which may generate $1 million of billables, will influence $100 million of assets under management. And sometimes they'll tell you that they got 4 or 5 clients that have a total of $100 million of assets under management. I don't know about your practice, but in our agency, which is the largest in our carrier, we've actually, through using CPA partnership programs in the last 5 years, have averaged somewhere between 15% to 22% of our total revenues in life insurance commissions from CPA alliances. On the investment side, we're the leading agency in our carrier for assets under management in GDC. So one follows the other. But my point is, how long do you think it takes the average advisor to accumulate $25 million of assets under management, given his own? This is a much more direct, faster route to that path. So who benefits? The reality is it's a win-win-win. You know, Covey's 7 habits. It's win-win or walk. So the client gets integrated collaborative approach. They get comprehensive and convenient service in one place, which is going to be critical for millennials. And they get CPA oversight. Post-Bernie, I mean, it's been a few years, but it's always good to have a second pair of eyes on the work, even if you trust your advisor. So Madoff didn't change the industry, but he heightened awareness. From the CPA perspective, we said we're going to improve client retention, generate client referrals, increase the firm value. Today, I said because of the buyer's market, values have dropped from 1.2 to 0.9. What do we know about assets under management? Linsco Private Ledger is selling them for 2 to 2.5 times annual recurring revenue streams. So if you want to increase your firm value, are you going to build a department that's growing at 2 to 2.5 times? Or are you going to still focus on the 0.9 to 1.0 return on your billables? Increased revenue, it's 5 to 15% of billables on each side if done properly. That's not a given. There's a lot of work that has to take place for that to happen, but that's the realistic expectation, and that's a bogey. and you're going to provide competitive positioning. People won't be leaving your practice as a CPA to go somewhere for this kind of help because you don't offer it. The advisor wins because they have access to high net worth clients and business owners, and they leverage that CPA's trusted advisor credibility. We said that CPAs are doing this. I mean, at the end of the day, they have a PFP section for financial planning. That's a very active component of the AICPA. They have their own meetings, their own CPE. They've created the 360 Degrees of Financial Literacy website. It's outstanding. You could literally train financial advisors on that website. It's that thorough. They have something called Feed the Pig, Benjamin Banks. It's a program for children and teaching them how to save. It's outstanding. They've got their own designation, personal financial specialist. There are now 7,000 of them and growing. They also have one of the largest enrollments in the CFP and probably the highest pass rates. So they have their eyes focused on this. They know they're going to change their branding from tax and accounting to advisory. And they know that designations and expertise and credibility is key. One of the things you need to do is kind of align the services and the way you work with clients with the way they think. You know, the 1040 and 1120 are processes. They don't start at line 27, adjusted gross income, and fill backwards. So we talk about really our financial management life cycle and the kind of people we work with. We're not there to cherry pick. We're really there to help all their clients if they want the help. So we really take them through a build and protect wealth, manage the wealth, maintain the wealth, distribute the wealth in retirement, and then transfer wealth either at their demise or when they want their kids or church or whoever to have the money. So it's launch, rise, success, retirement, and legacy. We talk about transfer, what it involves, just kind of connect and ring some bells. And then we talk about distribution and what it's going to mean and why people need to start planning for less than 3% of their principal distribution to last a 30-year retirement. All issues they're pretty aware of, but we kind of share the graphics with them pretty quickly. So they understand what we do. It's really life events and family dynamics as opposed to products. I talked about a business model being critical. So I work with a lot of partnerships. I don't work with any CPAs. I don't work with any property and casualty owners. I don't work with any law attorneys. I really work with business owners who just happen to do those things. If they don't think like a business owner, it's going to be a very challenging partnership. So the 4 pillars of the program that we built, first one is pretty basic. It's market to existing clients. Now, if a CPA has 1,000 clients, what you have to understand is they probably know 250 pretty well. They have an acquaintance with another 250, and 500 they may never see. Their staff does the work. They may say hello to them, but they're not that familiar. They don't have the intimacy that you would think with the 500. So you don't want to put them on the spot saying that, you've got 1,000 clients, there's a huge opportunity here. You manage expectations. I would say if you've got 1,000 clients, through effective marketing, we can probably attract 50 new clients from your practice. Our job is to create raving fans of those people so that we can go to the second pillar. Now, I won't talk about revenue splits. I don't, in fact, spend other people's money. I do coach people on what splits work best, and we'll address some of that a little later on. But the reality is our job is really to create raving fans, add value, create that stickiness, and help the clients that want their help. Now, one of the things that they'll tell you is, well, I've been feeling 55 years old. My clients are 5 or 10 years either side of my age. Most of them are taken care of. And you and I know that's just not so. And you've got to have a sidebar discussion with that and why that might not be true. The second pillar is replication. We explain to the CPA when we're done with their client engagement, we ask one question. Of all the things we've done for you, your family, or your business, in your opinion, what brought you the most value? How have we helped you best? And it really doesn't matter what the answer is, the buy, sell, the estate plan, the 529 plan, doesn't matter. We want to know what they think the value is that we provided. Because our pivot point then becomes, well, who do you know and really care about that should learn what you learned during engagement? So when and if they have to make financial decisions, they're empowered to make an educated decision. So for every client of theirs we work with, we tend to get 3, we would call them referrals. I don't use that term in the presentations, but we'll get 3 people that we're getting favorable introductions to from their clients. The reality at the end of the day is, if we work with one of those 3, we'll get 3 names from those. I tend to suggest that advisors and split referrals in the first level with their CPA, just as if they were their clients. So if it's a 50-50 deal on your pillar 1, you should probably do 50-50 on the first level of referrals in pillar 2. The third pillar is pretty interesting. We are able to create LLCs. I'll talk about that in a few minutes, so that we can use a business card with the CPA's brand on it. And it results in us introducing the CPA to the referrals that we meet from their clients. And more importantly, it gets to introduce the fact that we're tied to tax and accounting practice. Our experience is that 1 in 5 of the referrals that we get and do business with, since they're now already, in fact, a client of the LLC of the CPA, we're able to convert them to the CPA for tax and accounting work. And that's a huge benefit. So if you look at the first 3 models, it's not about just mining the clients of the CPA, which is the approach and mistake many advisors make. We're going to market, respond to the 50 that ask for help, replicate them, and then add new tax and accounting clients and help them build their accounting practice. You almost become a business development arm. I visited a firm in Miami, 7 partners, pretty uniquely, that 6 of them were CPAs and 1 had no credentials at all, wasn't even an accounting major. He was in charge of business development. And all he did all day was go out and talk to businesses about the value proposition that 6-partner practice could add, and why they were the best small business CPAs in Southern Florida. It was an interesting dynamic, and it was working pretty effectively. Charlie Ratner, when he wrote the book on financial planning, said that the real success, the real opportunity for revenue is in pillar 2, not in pillar 1. It comes from multiplicating your clients and finding new contact points that you wouldn't find on your own. So how do you select the right partner? Well, you have to keep in perspective that CPAs by nature are historians. They're not reporting 2022 taxes this year. They're reporting 2020 taxes. They see the world in a rearview mirror. They're reporting what happened. On the other side, we're conceptual people. We're talking about what if. What if you live too long, die too soon, get disabled, need long-term care? So that concept is mitigating a probability, but not an event that has actually happened. So again, you want to look for a business owner who happens to run an accounting practice, a CPA. I like payroll companies because by definition, all their clients are business owners. But you want someone who shares similar values. You have to align philosophically with whoever you partner with. They have the right client base. I don't mean this wrong, but I'm really not going to waste people's time by plugging them into a situation where there's a lot of $99 returns. It's just not a good use of anyone's time. I want a CPA who's willing to be a client. I want them to understand the kind of service we provide and what the process looks like. I want them to have a partnership mentality, and there's not much of an investment that needs to be made, but I'm looking for someone who's not afraid to take some kind of investment in their business. So the characteristics, we focus on 1 to 5 equity owners. There could be more CPAs in the practice, but I'm concerned with equity owners. I want to have as few decision makers as possible. If you get a 9-partner firm as an example, 3 are young people, 3 are people that have been there for a while, and 3 are senior guys. The 3 senior guys aren't going to change much. They're looking to create an exit strategy. The next 3 people aren't going to cause any waves because they want to be the 3 that take over. And the youngest 3 people know they've got a hill in front of them, they've got to climb, and they're looking for all the revenue help they can get. But the reality is there are only 2,500 firms in America with more than 5 equity owners. So if 95% of your market is 1 to 5 equity owners, I would suggest you probably will have the greatest success there, and there are more of them than you probably need. I'm looking for a firm that has minimal test work. A test is audit, review, and compilation. Their canon of ethics really says that they have to be independent and objective in dealing with those people. and they really can't offer them other services. Now there are firms that will define that and say, well, we can work with the executives, we just can't sell 401k and group health. The reality is we wall off all the test clients when we do marketing. We don't want to have any gray areas. We just kind of cut it off, build a wall, and move on. I'm looking for a firm that's got $500 to $2 million in gross billings. If my opportunity is 5 to 15% of the gross billings for their share and the same for mine, I'm looking for a business opportunity. We're basically, if you look at our model, spending 4 to 8 hours a week, and most of the firms we partner with, we become an integral part of their operation. So time is money, and we want to make sure we're in the right place with the right opportunity. I like people who are already licensed and not meeting the benchmarks. They believe in offering the services. They just haven't found a model that works well for them. So to me, it's a single sale versus a dual sale. I don't have to convince them that, yeah, you should do this. And then, yeah, you should do it with us. If they're already doing it and not meeting benchmarks, it's a much easier conversation. I'm looking for people who have a mindset to share revenue. There are people who don't. There are a lot of CPAs my age who just don't feel they're comfortable with that, and that's fine. Listen, we'll talk about this. This is an opportunity of plenty, not scarcity. I mean, there are 837 CPA firms within 45 minutes of my office in Conshohocken, Pennsylvania. There's plenty of people to talk to. I'm looking for someone who does 500 individual returns and maybe 100 business returns. And again, we talk about payroll providers are, I think, first rate. Now, it's just not CPAs you should be looking at. You should become familiar with enrolled agents, EAs. They're similar to CPAs. Their exams aren't quite as rigorous. They can't do audit and attest work, and they can't represent their clients in front of the IRS. And those are the basic differences. They tend to work in the small business arena, and their price point's probably a lot lower than the CPAs. They're not really well regarded by CPAs, but the reality is the relationships are great, and they're a hidden market. So I would suggest you focus on EAs. Accountants who aren't CPAs or EAs are diminishing because of the requirements by the IRS. But the reality is there's nothing wrong with that if you can find the right partner. So the 3 questions to level the playing field. Would you be willing to share with me your 3-year written business plan to grow your firm? I've been doing this for 22 years in the 1 to 5 equity owner marketplace, and I've probably seen less than 5. They just don't exist. I kind of smiled and I said, I know you don't give that advice to your small business owners when they're looking for loans or trying to do reportings to their partners. But the reality is, if you could or would, we can align our marketing strategy and our marketing plans with yours. I asked about the core value proposition. There's 837 firms in 45-minute drive. Why you? What is it you do so special? The most common answer is our clients like us. That's fine. I'm sure they do. But the reality is, what is your value proposition? You don't have a special 1040. You don't have a special 1120. So what are you doing that's causing clients to come to you and clients to stay? They may like you, but maybe it's the attention you give them. Maybe it's you make them feel as important as your biggest client. But most of them haven't given much thought to that. And then I ask them, what does an ideal new client look like for your firm? And I know that it's one person that pays them in 4 ways, whether it's audit, consulting, personal work, business returns. But it's kind of interesting to watch their reaction. We've got a threshold of $300. That's the way they look at a new client. And I tend to ask questions like, well, do you have a list of 100 small business owners who would most benefit from your core value proposition that you could help best? And, that's the old hedgehog client mindset. Find somebody you like working with, find somebody that you have a unique solution for a unique problem, and they can afford to pay you. So have you built that list? And they just don't. They don't think that way. A couple of opportunities that I think you should be aware of. The American Society of Certified Public Accountants for women is pretty critical. 61% of all accountants are females. 81% of firms have modified their work hours to flex hours. The biggest challenge we have is there are a lot more females taking the CPA exam than there are males. And what happens is, if you understand the business, for the first 4 months of the year, People work most weekends in accounting practices. And that's fine for a single female, but once you start a family, unless you have great flexibility with your spouse's career, it's tough for you to be away for 13 weekends in a row and working 60 to 70 hours a week during crunch time. So there are some challenges. The good news is firms have learned to hire people that have left to raise families. They can now work better from home because of Zoom, and they can work limited hours and work around school and issues like that. I will tell you this, that female owners, they only represent about 27% of partners and principals, have the most success with our program. They tend to follow the plan. They stick to it. Again, the diet analogy. I mean, if you can stick to it, most diets will work. You control your intake and do a little exercise. So we're looking for ways, like most agencies in the industry, to hire more female advisors. We think there's a phenomenal opportunity, not only today, but going forward. The National Association of Black Accountants celebrated its 50th year anniversary this year. There are 5,000 Black CPAs of the 650,000 in the United States. Only 5% of Black college students graduate with a degree in accounting, and that's less than there were in 1979. And of the 46,000 CPA firms in the United States, only 3% of new hires were African American. I will tell you, we've worked with two of the largest African American owned accounting practices in the United States, and there is phenomenal opportunity there. It's a wonderful opportunity that I think you should probably look at and pursue. I think you'll realize great returns. So what are some of the competitive advantages and opportunities? I mentioned our LLC structure. I think it's pretty critical. We're allowed to form an LLC that the CPA owns. It allows us to brand. So if it's Phil Raymond CPA, we may create Phil Raymond Financial Services LLC. Our advisor becomes a 1% non-voting, non-equity member. It allows the LLC to offer all those services for which that advisor is licensed. It allows our advisor to carry that business card so that when they're introduced to a client, they don't have to explain how the partnership works with 1847 and everyone else. They become perceived as an integral part of that CPA practice. It allows them to sell off the LLC without selling the CPA practice. It creates a firewall. FINRA and the State Insurance Commission can come in and audit, but as long as you don't integrate files and you keep your LLC structure separate, and that's usually a file drawer with a lock on it, all they can audit is those files. So you're not going to risk being interrupted during tax season with an audit from either of those regulatory environments. And then the next one is that we can provide hybrid models. It's not just do a firm assessment, do a marketing plan, do a business plan, take our 10-week rollout to market, put a person on site for 4 to 6 hours a week. We have some flexibility, and there are hybrid models that work. I'm a proponent of structure. I think out of sight, out of mind is a big factor in why some firms fail in their partnerships. The reality is, if someone asked me, the key to success in these partnerships, it's an on-site presence, out of sight, out of mind, and have someone that's going to drive it. So they get to leverage our time, skills, and energy in return for leverage relationships. Again, they're working 2,500 hours a year. They're not looking for more work. I mean, the reality is, when they're done with tax season, they want to take a month to decompress. They want to be with their families. So if they can leverage your time, skills, and energy to increase the top line, and it goes right to the bottom line, we'll talk about that in a minute, it's a great opportunity. 10 to 15% of top line revenue opportunity. If you understand the next bullet point on how CPAs make money, for every dollar they bring in, about 30% goes to overhead. Now, our on-site presence and overhead may change. One of the things you'll see with COVID in the effectiveness of Zoom, smaller CPAs are realizing that they can delease. They want to get out of their space. They think their staff can work remotely pretty effectively, and they're seeing clients that are actually being able to adapt to that model. So that 30% may change, but today it's about 30% for overhead. Their software tends to be very expensive. 35% of that dollar is going to people. They're the most manpower intensive professional discipline. It just takes a lot of bodies to get the work done. And then they take 45% to 50% home. So 2 partners doing $1 million are probably carving up 500,000, 250 each. If you can generate 15% of that $1 million in new revenue without them working, that's 150 grand, 75 grand a partner. That's meaningful. And again, it's a true business model for business owners. So the referral talk that I use is pretty simple. I encourage all our advisors to, during their quarterly review with their clients, to ask their clients 4 questions. Is Phil Raymond still your CPA? Or if you don't know, who is your CPA? And if our advisors don't know who the CPA is, the lawyer is, or the PNC agency that client works with, shame on them. But is Phil Raymond still your CPA? And then the next question you want to ask is, what criteria did you use to select Phil Raymond as your CPA? The next question that you would ask your client is, what do you like most about working with Phil or the firm? And the last question is, do you or would you refer friends and or business acquaintance to them based on the work they do for you? So the first 30 seconds of any call, and CPAs have been doing this since 1993, they're inundated. Everyone's trying to steamroll into the deal. The reality is you got 30 seconds really to get their attention. So the first 30 seconds is pretty critical, and I would start with this. Dick Clark, CPA, this is Phil Raymond. I was meeting with my client, Bill Smith, doing our quarterly review. Bill's been my client for 15 years. Pause. What have we just done in the first 30 seconds? I do quarterly reviews, which they don't believe. I have a client for 15 years that I know is a client of theirs, so I must be doing something right, and we fish in the same pond. And then I would go on to say, during the meeting, I asked Dick the following questions. He said, yep, he was still working with you. He was happy to be working with you. I asked him how he selected you, and he said he thinks you're probably the best advisor in the small business space that he knows. What he likes most about working with you is your golf outing, but more importantly, everyone on your staff makes him feel important every time he calls. And then the last thing is, I asked him if he ever refers friends or business acquaintance to you for work. And he said he'd be more than happy to, but you've never asked. And then you go into your little 5 or 10 minute presentation and go on from there. And I would tell you your appointment rate is going to be somewhere between 50 to 60% using this approach. Tough for them to say no if you share a client and you've asked that client if you can use their name in the introduction to the CPA. So what are the challenges? It's not for everyone. Some advisors have no need. It takes a lot of time, and you may not have the talent, unfortunately. A lot of our young advisors, we sell a team basis. CPA is not foolish. He knows that someone that's been in the business 3 years doesn't have all the answers and doesn't want them to be exposed to their best clients. So if we're using a young advisor, they may be a concierge and direct people to other members of their team. So no need, no time, no talent. It's a long runway. This is farming, not hunting. The reality is it's a long process. It's an 8-page assessment. It's a 25-page marketing plan. It's 10 weeks, week by week, on how do you get to market. The analogy for farming is you got to cut the trees, pull the stumps, plow the ground, plant the seeds, fertilize, weed. And you may not get a good crop the first year, you may get it the second year. It's not elephant hunting. So there's a long runway. And the challenge is a lot of advisors don't have a long runway, especially those that are new in the business. So you have to take that in consideration when you're looking at this model. A lot of moving parts. It's a process, not a transaction. You've got the client, you've got the advisor, you got the CPA. It takes required coordination and alignment. And sometimes getting all the ducks in a row is a little frustrating. It takes some patience to get it done. When there's opportunity, there's a limited hunting season. At the end of the day, tax season starts probably February 1st. They'll go hard through April 15th if they've got a tax practice. When they're done, they want to decompress for a month. So the earliest you're probably going to see them is mid-May, and then they've got returns on September 15th. They've got extensions on October 15th. The county's getting to be a 12-month a year, 12-month a year job. And it's just not a tax season, but you have to understand there are times when it's impolite to really bother them. And then licensing and supervision are issues, especially the compliance work that goes along with it, that you have to be prepared to discuss. So the opportunities, I think if you have a competitive advantage that's focused on helping them solve their issues and not yours, you'll get their attention. It is abundance, not scarcity. There are plenty of them out there. Yes, there are a number that are doing it very well, but there are a number of them that are not and probably will have to. They're easy to identify and approach. You can buy lists that tell you what their billables are, where their locations are, what the names of the partners are. The reality at the end of the day is most of them meet at least quarterly for CPE with state societies. And as one CPA told me, he said, Phil, if you can't come to one of our CPE meetings as a guest and sit at a table with 8 CPAs and engage, then you probably are in the wrong career. And he's right. They're easy to identify. They're fairly easy to approach, but you really have to know what you're doing. The reality is you're late to the dance, but the good news is the band's still playing. And it's not if, but when they're going to do it. You have to understand and believe that it's not if. They'll all be doing it. Their society sees the opportunity, and they're going to need to do it as their business model evolves. We can stop for questions here, or I can continue for a few minutes and talk about where I started this process years ago in the property and casualty space. There are some challenges. The reality is 95% of the P&C market is saturated. Everyone's got their home, their car, their second home insured, maybe their RV, the motorcycle. 5% of the marketplace is first-time homeowners, first-time car owners, first-time business owners. And firms can't grow with just that 5% market opportunity. So they've been commoditized by price. 15 minutes will save you 15%. I'm sure you've heard that numerous times. And basically what they're saying is we'd like to keep our people and steal some of yours because that 5% really isn't robust enough for us to grow our businesses the way we want to. Our business isn't really at market saturation. In 1970, the population was 231 million. There were 18 million life insurance policies sold. 2020, the population was 330 million. And depending on what statistics you look at, somewhere between 9 million and 13 million new life insurance policies sold. And part of that is there's been a dramatic decrease in the number of life insurance agents in America. In 1988, there were 244,000. And today there are only 145,000. That's a significant drop, and I think it's getting even more dire than that. Internet marketing and 800 service centers are really interrupting their customer relationship. You know, I was telling someone the other day that I've been with my nationwide property and casualty carrier for 18 years, and I have yet to have one single call with a live person checking in. Yeah, I get my renewal rates. I get an explanation of my deck sheets. I get an explanation of what the torts look like and what they should be. So they've got much less than average quality customer communication. The reality is, and I started building alliances in the P&C space. My mentor taught me how to do it in the early 1980s. And I've always had a holistic risk assessment approach to the property and casualty space. You know, risk mitigation can be defined as really determining the probability of an event and the consequence of an event. And, you know, you ask most people what their most valuable asset is, and they'll tell you their home. Well, the chances of your home being totally destroyed in your lifetime are 1 in 16,000 approximately. The chances of your car being totally destroyed in your lifetime are 1 in 400. The chance of you needing disability in your lifetime are 1 in 8. My dad got MS when he was 36 years old, never walked again, and I can tell you it had a dramatic impact, not only the income stream, but the expenses that our family incurred. The probability of needing long-term care in your lifetime are 1 in 2. My mom died from COVID in December at 96 years old, and it was costing us $10,000 a month for nursing home care. So the chances of that are 1 in 2. And of course, I always ask people if death runs in their family, the probability of dying is 1 in 1, and the consequence varies. If you die at my age at 74, hopefully a few people will miss you, but the economic impact's not going to be as dramatic as a 32-year-old with 3 kids and needing both incomes to meet their budget requirements passing away. So the reality at the end of the day is things are going to change. I don't know, what the automobile insurance market is going to look like going forward, but I can tell you that, my wife's Q7 parks in the garage. She works from home, recruits CFOs, and that car doesn't move. It does probably 4,000 or 5,000 miles a year. Doesn't make much sense to me to pay $70,000 for depreciating an asset that you use probably a half an hour to an hour a day when you can have pooled ownership or vehicles that drive themselves or other forms of transportation. So I don't know what their model is going to look like, but I know that they can't survive just on auto and homeowners. They've got to expand their holistic risk assessment to include other events that have a higher probability and probably a much higher consequence. Loss of income for people being disabled for 90 days or more. I think the chances are 1 in 8 between 90 and 65 for 90 days or more. I've seen during COVID people waiting for their relief checks because they don't have 90 days of liquidity to cover their budget needs. So there are a lot of issues. I think that industry is going to change dramatically. I think there's a great opportunity there. They are transaction focused. And at the end of the day, they make quick decisions. Everything they sell is term insurance. If you don't use your homeowner's policy, it expires. You get to have a new one next year. If you haven't had any claims, you may get a favorable rate. A hurricane goes through and you have a high claim, maybe your rate goes up. Car insurance is term insurance. So they tend to view the world like that. Not many of those insurances have a value, an intrinsic value like cash values that life insurance may have, or provide an income stream like disability insurance or long-term care might.